Welcome back to FFS for Finance's Sake. I'm Rachael Chadwick-Harrison, Chartered Accountant and Managing Director of the leading firm Chadwick Accountants here in Warwickshire. And this is How to Pay Yourself as a Company Director in the UK, our March tax planning secrets. Today, I'm walking you through something every business owner thinks that they understand, but very few truly optimize without the help of a really great accountant. So how to pay yourself properly or most tax efficiently as a UK limited company director. Not what your mate down the pub does, not what a random blog from 2018 says, and definitely not just take dividends because they're cheaper. This is what we actually do with real clients in real business making real profits. And I'm going to tell you all our secrets. So, firstly, why March is where the magic happens. Every year we sit down with our clients in March, not April, not sometime in the summer, not what's sorted at year end, March, because March is the end of the personal tax year. At that point, we know exactly how much salary has already been paid, dividends taken so far, their rental income, pension contributions, other employment income, whether someone's drifting towards 100k, whether they've accidentally become what we call a band burner. In April, you're guessing for the next year. And I don't guess with clients' money. If we planned in April, they might hire staff through the year, their NI allowance might change, profit projections can change, and tax bands can get used up in other areas. So March gives us clarity. And clarity equals precision. Precision equals tax efficiency. So how should a company director pay themselves? Here's the truth. There is no one-size-fits-all answer. It depends on a lot of factors. So if you're with me, get a pen and paper and write these down. Are you the only person on the payroll? Do you have any staff? Is employment allowance available? Are you already earning elsewhere? Are you part of a couple? Is your company profits under 50,000, between 50 and 250,000, or over 250,000? If you're making between 50,000 and 250,000 taxable profit, you're in what we call the marginal corporation tax zone, and that slice of profit is effectively taxed at 26.5%. So every extraction decision matters even more, because extra salary reduces the profit that will be taxed at 26.5%. But salary can trigger employers' NI and possibly employee NI. Dividends avoid NI, but they're paid after corporation tax. This is why proper modelling matters. This is why we plan at the end of the tax year. And this is why just take dividends is lazy advice. So let's look at the overarching non-negotiables here. Before we even talk about the split of salary versus dividends, there are some rules, and these apply to everyone. Rule number 1, avoid your total income going over £100,000. Between £100,000 and £125,140, you lose your personal allowance. Your effective marginal tax rate is actually about 60%. It's one of the most punishing bands in the UK tax system. If we see a client drifting towards 100k, we'll adjust extraction immediately. We do not accidentally fall into 60%. Rule number 2, if you're a couple, coordinate. If income must exceed 100k, have one partner smash the band and the other stops at 100,000. Don't let both of you drift into 60%. That doubles the inefficiency. We plan households, not egos. Rule 3, think household, not individual. If someone in the family has an unused basic rate band, why are we pushing a director into a higher rate? Income splitting, where legitimate, is normal planning. Payroll for genuine work, properly structured shares, dividends in proportion to the ownership. It's not aggressive, it's competent. So let's go on to our 4 director types. Every director fits into one of our 4 categories. And once we identify it in March, the strategy becomes clear. So I'm going to talk you through this. First one we have is called the lone wolf. This means you're the only one on payroll. There's no employment allowance available. Your best structure usually looks like £5,000 salary with no NI exposure. Then dividends. Because salary above the threshold quickly stacks up. You've got 20% income tax, 8% employee NI, 15% employer NI, and that's around 43%. Dividends, even after corporation tax, often cheaper. Then we have the hive builder. This means you have a few staff, but there's still some employment allowance available. You're not using the whole allowance to cover employers' NI. Salary here over that 12,570 can cost 28% for basic rate taxpayers, 42% for higher rate taxpayers. Dividends after corp tax and dividend tax can cost more. So here, payroll can actually win, but only until you use up all that employment allowance. This is why we do it in March, so we can bump those salaries up until the point that you've utilised all your employment allowance, and then the rest goes as dividends. The fully loaded. You have a team of staff, but your employer NI bill already exceeds the £10,500 employment allowance. Now payroll's getting expensive again. So under the current rules, it typically works to do salary up to 12,570, even though you will incur the employer's NI, and then dividends. It's clean, efficient, controlled. However, thanks to Rachael Reeves putting up the dividend tax by 2% next year, it doesn't work out quite the same, and you'll need to do a little bit more digging to see which corporation tax band you're in to work out what will work for you. But for the 25-26 year, salary up to 12,570, then dividends. I just want to go back to the 50k to 250k profit trap, where that marginal corporation tax comes in at 26.5%. So that slice is effectively taxed at 26.5%. So what you need to ask is increasing the salary worth it to reduce the profit tax at 26.5%? Does the NI cost outweigh the corporation tax saving? Would pension contributions be more efficient? Should dividends be accelerated before year end? These are March decisions, not April regrets. The Chadwick rules, how we actually do it. Don't drift over 100k. Don't let both partners hit the 60% band. Use unused family basic rate bands. Identify band burners early. Know your director persona. Review marginal corporation tax. Plan in March, not April. So if you're a UK company director wondering, should I take salary or dividends? How much do I pay myself? Am I paying too much? Should I increase payroll before year end? The answer isn't guesswork, it's modelling, and it's why we do it every March. So thank you for listening. I'm Rachael Chadwick-Harrison, Chartered Accountant MD of Chadwick Accountants in the beautiful Bidford-on-Avon. Please get in touch with us if you'd like any assistance at all at info@chadwickaccountants.co.uk. There are secrets to paying yourself tax efficiently as a UK company director. So until next time, FFS, check the numbers.